Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so really excited today. I've got a good friend of mine, Ned Brines. I've known him for a couple of years now, and he's just been really helpful. Just a huge value add person. Just a really good person to just get to know over the last couple of years. Ned, what I'm going to do is I'm just going to give a quick intro to Ned, and then Ned's going to go a little deeper on his career. But Ned is the Chief of Investment Strategy. He's pretty much managing the investment portfolio for a single family office with diversified holdings, which include direct investments, internally managed portfolios, public and private, and also just looking at it, really interesting managers. So excited to talk about all things asset management, whether it's on the public side, the private side, direct investments. He's at Arnell and Affiliates. And he's been kind enough to just make some time for me and the community to kind of talk about his story. So Ned, welcome to the show. Why don't you introduce yourself and unpack your introduction with a little bit about just your early education, where you grew up, and just walk us through kind of the story of how you got to where you are now. And I might, if it's okay, I might interrupt with some questions or just kind of clarifying things so the audience can get to know you better.
Yeah. Joel, listen, pleasure to be here. I've enjoyed getting to know you over the last few years as well, and love what you're doing. Love how you're giving back to the community. So thank you from the community, because I think it's an invaluable service, and I think it's helpful. I was involved with one of your venture cohorts a couple years ago. I think that was really beneficial. I spoke to another number of the managers afterwards, and they're really getting a lot out of it. So thank you for making the community better.
My pleasure.
So where would I start? I've been here at Arnell. We're a single family office in Orange County. I've been here for 9 years now. I run all the investments as you mentioned, and we're a split house. So half our assets are in real estate, half our assets are in other investments. The founder, George Arjos, was an unbelievable moneymaker. He could make money, pretty much doing anything, and did. Was a real estate developer. We're one of the largest apartment owners in Southern California as a result of his efforts there. It was involved in private equity. In those days, we just called it investing. So there wasn't really a private equity moniker. And he made money in airlines. He owned Igloo at one time, made money there. Made money in cable billing companies. Little technology companies, Sterno, the little fire things that you put under your food when you're having people over the house. Own that business at one time. So he's made money in all kinds of crazy spaces. At one point, owned the Seattle Mariners as the sole owner of that team. As you can imagine, made some pretty decent money with that as well. So just a fantastic moneymaker. And I'm the first outside person to come into this office and manage money. George unfortunately has Alzheimer's and can't invest any longer. So I had the daunting task of stepping in and kind of filling his shoes a little bit. It's been fantastic. It's a great family to work for, and they give me a lot of leeway to try and make money how I feel like I'm best at making money, as opposed to trying to fit into some other kind of mold. And I think it's worked out well. Not to make this a victory lap, but we just got our 1, 3, 5 year numbers versus the foundation endowment universe for our foundation, and we're number one across all those periods. And unless something disastrous happens this year, we should also be number one after the 10-year number as well. And that includes competing against Harvard, Yale, and all the big endowments. So we're pretty proud of those numbers. Going back all the way to the beginning. So I studied physiology in school. I started about a semester or two into college thinking I might go to medical school, and realized I was having too much fun and working too hard at other stuff to really be a dedicated student to get the grades to get to med school. I ended up I started pursuing a double major. I was about 3 classes short of a second degree in finance. And when I started taking the business classes, I just kind of I thought to myself, you know what? This is really what I should be doing. I had a natural affinity for it. I understood it. It made sense. I mean, I didn't have to study in those courses at all. So I went to work in investment banking, and that's as you know, that can be a grind, but it's also a great learning experience and I learned, listen, hard work and a lot of it. The joke was always, what's a Sunday, right? Because we didn't, every once in a while I get a Sunday off. But we worked hard and learned how to, I think the formation of my investing really started there. How do you identify value coming out of a business? Where's the cash come from? What are the value drivers inside of a business? And I think that was just a critical lesson that has stuck with me my whole career. Whether we're investing with individual companies or managers, at the end of the day, how do you make money? It's got to translate down into that bottom line. So I think that was a kind of a critical lesson there. I'll pause in case you want to interject.
So any advice that you have in terms of, number one, finding what your pathway is? I think for you, it came naturally. For me, studied electrical engineering, and, I had the similar self-realization. I don't want to sit in a lab underground and write code. My favorite class in college was engineering economics, and it's essentially where you're pitching a business. So I had 2-3 other people, put together the designs of some circuit that we built, and I just came in front and pitched it. So I just, I think similar to you, I love working with people, and just kind of that self-realization came to me. There's several people that go out and switch careers 3 times. There's some people that change their majors 3 times. So, are you recommending just to kind of just enjoy the journey and figure it out? Or what are some frameworks that maybe helped you decide that banking was the path?
Yeah, well, I'll take a half step back into education because I think it's important. I don't think it's as critical, unless you're going into a technical field.
Mm-hmm.
I don't think it's as critical what you study versus building those learning capabilities. Can you take in, and we have a ton of information today, as you know. I mean, the amount of information flow is enormous.
Sure.
Can you take in large amounts of information, filter it to what's relevant, and then make decisions? And I think that's the value of education. So whether you're studying philosophy or psychology or finance or engineering, can you boil down the information into an actionable item? I think that's the important skill that you learn there. I've met investors, other investors who are history majors. And you might say, well, what's the relevance there? Well, you know what? A lot of what we do is pattern recognition and looking back at historical periods and then looking for the parallels to the current period. And history is fantastic for that. Economic history is great for that. Understanding market cycles and how things repeat over short cycles and long cycles. So I think developing that ability to take in all that data and then consolidate it into some thoughts and conclusions that are actionable is the important part of the education. So I don't think it's so much what you're studying that's as critical. Going into banking, I don't know that banking was necessarily my passion, but it was for me, it was almost a bit of a means to an end, in that I wasn't really sure what I wanted to do. I was graduated, or you get ready to graduate, and I called my dad, who my dad had been a Hallmark Cards. Ultimately, he was a regional sales director for a Hallmark, and he'd been there. He ended up being there for 35 years. So I called him and thought, hey, what do you think I should do? And he said, oh, now keep in mind, this is May of my second senior year, because I took 5 years to graduate college. And he said, you should look at like investment banks and consulting firms, because you're going to see a lot of businesses over your first couple of years there, and you're going to see something that you might like and want to go to work there. So that was kind of my thought, is I'm going to go do this for a couple of years. I'm going to see an industry I really like, and I'm going to jump in and get involved. I don't think I really anticipated I'd be staying in the business, for 30 plus years. That was a little easier said than done, since recruiting had been finished for about 6 months. So I had to kind of barge my way in through sheer force into a small firm in Beverly Hills, where I legitimately called the guy for about 5 or 6 straight weeks, every day. Every day I call. It became like a running joke with his assistants. She's like, "Oh, good, you're a little late this morning." You know, I'm like, I had a late night last night. All right, I'll call you tomorrow. And then one day he picked up the phone and he's like, "What do you want?" And I had to I went from not anticipating I was actually going to get him on the phone. It was kind of had become a game to, wow, I need to pitch this right now hard.
Sure.
And I pitched it hard that, listen, you need me in this class, and here's why. And I just started laying out reasons why I thought I could be an invaluable asset to that analyst class, and he took me.
So we're going to talk about, so that's a good point, right? So we all heard this story. I don't know if you heard this story with Vinod Khosla, like how he got into Stanford, right? I think he just showed up at the admissions office and just begged them every day until they got tired of probably hearing from him, and they let him in. And that hustle, that grit, was very present back in the day before we had LinkedIn, before we had, even the ability to find people's emails and stuff. You would literally just find people's numbers in a phone book. Even when you're doing fundraising, right? You go through the phone book and you're calling people. And if you're trying to get a meeting, what do? You call the landline and you just show up until they're tired of seeing you, and until they give you a chance, right? So it's brute force. Do you feel like that's changed now, with the recruiting process? Do you feel like, do you see that same level of grit when people are trying to find a job? And, we're going to go through an example in a few minutes that you allowed me to bring up, but do you feel like that's changed a little bit?
I don't see people doing that as frequently, but I do encourage people to do that, or to take a similar approach. And so I just taught a class this last fall at Chapman University on family offices. And I lecture at all the universities around Southern California, usually like once or twice a year. And regardless of what the topic is going to be, it always devolves into, how do you get a job in this field? So I always leave about an hour at the end because I know people are going to ask questions. And I have some kind of standard comments that I make, but I think they hold true. And I've told my own kids that, these same lessons, because I think they're important. One is that if you're going to try and find a job, and let's say you find a company that's advertising, you find a company that's advertising for a position. If I advertise for an analyst position, I'm going to get 1,000 resumes. Okay. I have the capability of probably interviewing 10 people, which is 1% of those resumes. So we're going to filter out 990 of them. You got to have thick skin. You can't take that as a criticism or a failure on your own end. That's very arbitrary. I would say that probably of the 10 we take in to interview out of that 1,000, I'm going to speculate that 90 of them could have been in the interview process. Okay. But it's a low percentage, right?
Sure.
So we're taking 1%. But I will tell you this. If somebody I know brings a resume to me and says, "Hey, I hear you're hiring. I know this candidate. You should talk to them. Here's the resume." And I'll take a look at it. And if they're qualified, they're going to go in the interview pile, right? So the point being, use your network, build your LinkedIn network, build your business network, however you decide to do it. And instead of going in the front door through human resources, where you've got, in our case, you're going to have a 1% chance of getting an interview, right? Go through somebody who knows me, and you're going to have, as long as you're qualified, you're going to have virtually 100% chance of getting an interview. So it's a much higher probabilities. So while you're not calling somebody every day, for 6 weeks to try and get in the door, you're leveraging your network in an appropriate manner to help you get in the door. If you're not getting the interviews, you're not going to get the job. It's, to go back to sports analogy, I coached sports for a long time. If you're up to the plate and you don't swing the bat, I can guarantee you're not going to get a hit. You may get a walk and get on first base. You may get hit and get on first base, but if you don't swing that bat, you are not going to hit the ball. And if you're not in the interview, you're not going to get the job. So goal number 1 is to get yourself into that interview. Goal number 2, obviously, is to deliver on the interview. And there's all kinds of, ways you need to practice and be prepared for that. But going back, it's build your network relentlessly, and leverage it. If you see an opening for a position that you really want, then go to your LinkedIn network and find somebody who knows somebody who works there, and get that resume hand carried in. You have a much higher probability of getting the interview. Now, the last resort would be, you don't know anybody. Okay, just throw it in and hope you get it, but don't anticipate you're probably going to get the interview unless you really just jump out on paper.
Sure. Absolutely. Well, would love to have you share that story. I mean, I think once you get the interview, I think part of it, one of my favorite comments is money loves speed. So you have the opportunity in front of you, and now you want to think about it. You've essentially have everything signed, sealed, and delivered. Now you want to talk to your parents. Now you want to decide. People aren't waiting around for you to make a decision. So, one example we wanted to talk about was a candidate that you were potentially going to bring on your team. We're not going to bring any names up, but maybe you can share that story, because I think that's going to really shed light not only for I feel that sales, dating, fundraising, jobs, it's all the same thing, right? You need leads, you need to get out there to connect with that person, and then potentially it turns into.
Joe, you froze a little bit there.
You still hear me?
Yeah, you froze for a
Okay,
second.
cool. Okay, did you lose the audio?
Yeah, completely froze for a second. But
Okay, cool.
You said dating, and then you broke. So
Okay, sorry about that. I'll fix that later. But anyways, I was just saying, dating, sales, fundraising, getting a job, it's pretty much the same thing, right? You need to connect with people, potentially skip the line because there's a lot of prospects, and you have to somehow convert. And we were going to share an example of someone that potentially had this opportunity. And then I would say the other piece is you could have an offer, but then you want to shop around, and then that might just be too late to shop around. You want to just hopefully just find the offer, make sure it's the right offer, and move forward. If not, you could lose out on that offer. So thought it'd be great to kind of run through that example with the potential offer.
I've got a few thoughts on that, and when I'll take the corollary to what you said on prospecting and selling.
Mm-hmm.
In that, if you're looking for a position where you're prospecting or selling something, say in our world, kind of an investor relations role, right? How you proceed with trying to obtain interviews and handling your communication and the emails and the text messages and the format of those, and they may seem pretty innocuous, but that employer is going to be looking at that and thinking to themselves, this is how this person is going to interact with my clients. So while it may be as simple, hey, thank you for your time, my suggestion is don't do that little half sentence, thank you for your time, or appreciate your time today. Really lay out a nice thank you email every single time, because that's going to reflect to them how you might treat their clients and how you're going to function in that role. So, every communication you have with that potential employer is important. To your point on taking a position and having an offer in hand, I think by the time you have the offer in hand, you better be 100% sure you want that job. To take it to the point of getting an offer, unless it's insufficient for some reason, but assuming you already know what the numbers are going to be and whatnot, once you get to the point of having that offer, you should really be ready to accept it. If there's something that's bothering you about the company beforehand, then you should bring that up in the process. Companies, because as somebody who's looking at for a potential employee, I'm dropping people out of the process all the way through till I get to my final candidate. If my final candidate looks like they're going to accept and then doesn't, that's a real problem, because now I have to go back to somebody I just deleted or start my whole process over. So it's very expensive. Many years ago, I had a young man, very smart, great, went through 12 interviews with us. We had started with, again, about 1,000 resumes, and we filtered it all the way down, excuse me, and ended up with him and brought him back in for the final, meeting. I handed him his offer letter and said, listen, just sign this. He was graduating in May. This was March. I said, pick your start date. I don't care if you want to come in September, October, November, go travel Europe, whatever you need to do, because when you get here, you're going to work your tail off. So I want you refreshed and ready to go. Okay, great. And he gets up to leave. And I said, wait, you need to sign that before you get out of here. He's like, well, I just want to check with my parents first, and have some conversations with them about this. And I sat there for a second and mulled over what he had said and was wondering, how did I miss this whole thing with him? Where he's not comfortable making decisions in a world where we make decisions all the time. We're buying and selling things, and sometimes you're upside down $100 million and you've got to, figure it out. And to pull a phrase from a TV show that was on at that time, I said, you don't get a lifeline. You can't call your parents for help. You remember that old TV show where it was kind of like a quiz show, and if you needed help, you would call somebody
Phone
on
a
the phone.
friend. Yeah. Phone a
Yeah, yeah,
friend.
yeah. So I'm like, you don't get the call in and
Yeah.
get help. And I pulled the offer and said, listen, this is going to suck, but it could be the best lesson you ever have,
Yeah.
because you're not ready for this job. And I made a mistake in assuming that you were, and I didn't really follow my process like I should have to ensure that you're ready for making these kind of decisions. And I tore it up and threw it away. And he left, cried. I felt bad. Great kid. I'm sure he's doing fantastic now.
Mm-hmm.
Like I said, super smart, top school. He's great. And my boss came in and said, when's he starting? And I said, he's not. He said, what happened? I told him. He said, oh my God. I said, but think about that. He's not ready for this role. So I'm a believer that if you're going to get to the point of having an offer, you should be ready to accept that offer, unless there's something in there that doesn't make sense. But you should already know what the numbers are going to be, within reason. I mean, and I asked him, I said, listen, are the numbers different? Are the terms different? Is there anything in here that we haven't discussed? No. So it was just, he wasn't totally comfortable making a decision. And I realized I wasn't comfortable having somebody who can't make a decision in a role where they got to make decisions.
Sure. And I mean, I would say even in the investment space, you're going to make decisions. I mean, you have the leadership skills to do that. And you're also going to be accountable when you make bad decisions too, so being able to handle that in tough times, your mommy and daddy aren't going to be able to help you, so being able to navigate through that yourself and learn from it and find great mentors to get through it is really important. So
I think, Joel, I think the biggest challenge I've seen over the last maybe 12 or 15 years, as kids are coming out of college with straight A's in elementary school, middle school, high school, university, and never had a failure, never been allowed to fail, never been allowed to make a mistake, always protected, always carried, involved in all the right activities. And I'm not negating any of that, because I think that's fantastic. But they don't know how to fail because they've never been allowed to fail or put in a position where they might fail. And the problem is, in life, you always have failures. And we learn more from our failures than we do from our successes. I can guarantee you that, because when you're successful, and let's use investing because it's an easier measurement. When you're successful with an investment, the first thought is, I'm really good at this, or, oh yeah, I knew that was going to work. And you don't realize, maybe if you're not discerning enough, and believe me, after having my tail kicked in for so many years over my career, the one thing I'm pretty good at doing is looking, saying, hey, here's where I did really good work on this transaction, and here's where I got lucky. Or here's where I did really bad work, and here's where I got lucky. Or here's where I did really good work, but I got unlucky, right? So separating out that luck versus skill. When you get your face ripped off in a transaction and you lose a bunch of money, you learn a lot more about yourself and your process and that delineation between luck and skill than when you are successful. And if you're not allowed to fail and make mistakes and then live with the ramifications of those mistakes, what happens is, instead of that happening when you're 15, you do something stupid, whatever, you blow something up, or I don't know, whatever you do that's dumb at 15.
You get a DUI or something.
Well, yeah, or you do something in school that's stupid, and you get suspended for a week. Okay, take the suspension, take your medicine.
Mm-hmm.
That's what happens, right? But parents will want to gloss that over and help their kids and keep them. They'll complain and they'll get the kid back in school, and then what the kid learn? Oh, nothing, right? I made a mistake, and there's no ramification. So now fast forward, and they're 27, and they're in that first job, and they make a mistake. And it's not just, oh, I made a mistake, I just lost my firm $100 million or something along those lines. It's worse, because now it's a personal affront, and they don't know how to react personally.
Sure.
And evaluate it, and say, oh, okay, I made a mistake. I'm going to fix this. This is my my evaluation process, and I made a few mistakes here, and you tweak this, and let's move forward. And it becomes a much bigger situation than it should be, than just, hey, this is a work issue, I made a mistake and we're going to fix it. It now becomes a question of their own personal value and their own personal abilities, and that's a problem. And then it could even parlay into other things. You make mistakes in your marriage, or in in raising your kids. And believe me, I got 3 kids. I've made every mistake possible. So we did that on purpose because we wanted to practice making mistakes. But you make these mistakes, and they just get magnified if you don't have experience recovering from them. So I think that's the one thing I've noticed in the last dozen or so years, is that kids don't have as much experience with mistakes and failure, and that sets them up for bigger issues down the line.
What are some of the bigger issues that you're seeing with this generation versus the other? Is it what I think you're alluding to is kind of the mental health part of it, right? Like, people think their life is over if a deal blew up, where in the long run, everything somehow is figure outable, right? I mean, it corrects itself somehow. You learn from it. Maybe you do pay a big cost, but you're still alive. You got your 2 hands, you got your 2 legs, you've got a support system, right? So do you feel kind of some of the, because of all that pressure, and it depends on, there's demographics that are tied to some of that too, right? People's upbringing, they're raised by tiger parents, right? And they're supposed to adhere to a certain standard. But do you feel that, in the last maybe 15 years, it's just tough for people to kind of get through that? And where do you see they land after that? Do they just get burned out and do something else?
Yeah, I think they versus maybe when I was coming out of school, maybe not as much resilience.
Mm-hmm.
So when there is an issue that comes up, a mistake or whatnot, and you mentioned mental health, there's this search for, I need a work-life balance. Oh, in investment banking, there was no work-life balance. You worked.
Sure.
Right. Work-life balance was, hey, you know what? Sometimes we're going to give you a Sunday off, right? So there's your balance. Go have fun,
Mm-hmm.
right? Watch some football games and have brunch somewhere. So if you feel like you need that balance early in your career, then I think it's important to pursue a career that allows for that. Right. If you want to be involved in these highly competitive fields, like investments, obviously investment banking and consulting, whatnot, these highly competitive fields, you're going to have to put that a little bit on the back burner, that balanced part of your life. It'll come eventually, right? One of the reasons investment bankers work twice as hard as everybody else is they get paid twice as much, right? It's not a, well, you work twice as hard and you don't get paid, or the flip side, you're getting paid a lot, but you don't work as hard. You got to work for that money, right?
Mm-hmm.
And that's a hard field. So you do get rewarded from a financial standpoint, but it's at an expense, right? There's an expense to your personal life, and you have to be comfortable with that. When people tell me they want to pursue their passions, I tell them, I think what's more important is do something that you're really good at, that you can get paid the most you can at, and then your passions become your hobbies. I have 3 things that I do outside of work, a few more than that, but effectively 3. I say the 3 G's, right? I golf, I garden, and I play guitar. Nobody's going to pay me to do any of those things.
Sure.
Okay, so those are just hobbies, and that's fine. So I work hard, so I have enough capital that I can go pursue my hobbies when I'm not working. The other mistake, and I see this a lot, and I think we're talking about the same person here, is that they'll go to work somewhere for 2 years, they don't like it. So then they switch because they're looking for a better culture, better opportunity, better cash, whatever. And then they switch again, and then they switch again. And it's kind of these 2-year runs. And so by the time they're 30, they've been out of school for 8 years, they've had 4 jobs, and they're trying to convince me that they've identified that we have the best culture and that we're the best fit for them, when in reality, they haven't been anywhere long enough to understand culture, much less identify what our culture is. So I tell people, unless you're getting, whipped at work every day, physically whipped, you ought to be thinking 5 years for your first job out of college. Get that base in, learn your craft, and learn the culture. You may ultimately hate the culture, and that's okay.
Sure.
but be able to understand what it is you don't like about that culture and what you're looking for in the next place. Otherwise, you're going to continually go hop, 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 hop. And just as a side note, when we bring in a new employee, we lose money on that employee for 18 to 24 months between them not producing anything, what we're paying them a salary anyway, because they're learning, the distraction from the productive people who are making the money. It's a distraction from our time. So that's a cost. And it's okay because it's an investment for us for the long term to build the firm better. But if you're leaving every 2 years, nobody's making money from you. Yeah. You're losing every employer money for 2 years, and then you're not giving anything back. And eventually people are going to stop hiring you. So I just think that I see that a lot. And I think what we're talking about kind of dovetails that resilience, that never have failed, and this constant hopping of jobs. I think all is kind of tied together from the same factors.
So it's a good segue to my next question. So I understand now that you're looking for someone that has a little bit of experience, at least, I would say 3.5 to 5 years. If I were to gauge, having a little bit of a track record, building some type of reputation at a firm, and also getting your money back, right? You hire them, they've got to stick around for at least 18 months to 24 months to kind of recoup the skills that they're supposed to be ramping up on. What are some other, because you guys are a multi-asset strategy firm, right? So when you're hiring somebody, what are some of the hard skills and soft skills that you're looking for?
Yeah, and I'll go with the soft skills first. It's interesting that as much as this is an investing role, this is just as much a psychology role. When people say, what's your day like? I spend 80% of my time investing, 20% of my time doing whatever I'm asked to do, and 100% of my time as a family psychologist. So, if you did the math, that's 200. There's a lot of soft skills that goes into this kind of role, because I'm not dealing with an institutional investor who understands just flat out numbers, right? That sometimes we're going to lose money in an investment. That's just part of what we do. If we're not losing money periodically, then we're probably not doing our jobs properly. We're not taking enough risk. Yet for a family, they may not understand that. So you have to have those soft skills. So the soft skills are important. And in fact, I will say, and I've said this at a number of universities, if I'm interviewing 2 candidates and I've had the question, it's never going to actually be this way, but they've asked, what do you do if you have 2 candidates who are exactly equal on paper and equal with skills and whatnot? And I tell them, listen, at the end of the day, if I really had that situation, it's going to be the one I want to spend 10 hours a day with. So you better have a good personality and be fun to work with and have some good perspective. Because if not, I'm not going to want to work with you. So that's important. On a skill set standpoint, if we were bringing somebody in that 3 to 5 year window of experience versus, say, somebody right out of undergrad, then out of undergrad, we're gonna expect them to have some good Excel skills, good Tableau, Canva, that kind of stuff, some understanding of financial statements, but they're not going to be expert at that, and we wouldn't expect that. Obviously, ability to communicate, and I think communication is critical in what we do. You can be the best analyst in the world. If you can't tell anybody what you're doing, nobody cares, right? You've got to be able to sell the story. So in that 3 to 5 year window, it's a balancing act. We want somebody with higher level skills who can do the analytics, who has good business judgment, who understands that a model is not an answer. A model just creates questions. When you look at a business, why are margins deteriorating? So that's a management question. Why are margins expanding? Hey, you say there's you don't really have any competition and you have pricing power, yet your prices are continuing to decline. Why? Right? So it's somebody who can take it to that next level and ask questions that come out of the analysis. But we don't want them too trained, because we want to be able to train them in our methodology and how we make decisions. And sometimes people will come in, or we'll talk to people who they're already developed a certain process for doing things, and it will become apparent that they can't switch gears and learn a little bit different, because we're different. Like, every family office is different. There's no family office that's alike that I know of. Everybody has something different, and the difference that I think for us is that we're investors first, allocators second. And even when we allocate, we feel like we're investing because we don't invest with a lot of managers. We do a couple managers, and we do concentrated managers because we want concentrated bets, because we believe that if you have conviction and you're going to bet on something, on an investment, then you better have enough capital there to make that if it works, you make a lot of money. And that obviously creates some level of risk. And a lot of people aren't as comfortable with that in the allocator roles, where they're more putting out a lot of capital to a lot of different managers, a lot of diversification to minimize any mistakes. We know we're going to have mistakes.
Sure.
We know we're going to have things that go down. That's just part of it. And sometimes it hurts, but that's kind of our objective. So we have to make sure somebody's not completely so far down the path of their career that they can't switch and adapt to what we're doing here. So.
Sure. Yeah, I'm excited to spend a couple minutes in the future about managers. I wanted to kind of complete the story as well with your career, right? So you grounded out in banking, spent some time there. Why don't you tell me kind of the next steps after that? How you got into the firm at Arnell, and whatever you're allowed to share. Would love to learn a little more about the founder, because you tell me that the founder had just a magical knack to kind of just finding returns in the investment. So would love to learn a little more about his character and some of the things that some of the skills that he's developed to kind of find great investment opportunities. So maybe we can go there, and then we can start talking about managers and how we think about allocation.
Yeah. I spent I left banking. I went to a restructuring firm. I did 3.5 years with a restructuring firm, and I think that the critical lesson for me there was starting with the end in mind. And I do this with every investment. Everybody who pitches you an investment idea is going to tell you how you make money in it. What I'm trying to figure out is how I lose money. What are the factors that are going to come into play to make me lose money here? And that's all in, kind of based on spending time doing restructuring work and looking at really good businesses that were in bankruptcy for various reasons. And so I always kind of start with that in mind. How do I lose money here? And if I can't A, understand how I lose money, and B, get comfortable with that level of risk, then we go to the next one. There's no FOMO here. We pass on a lot of stuff. We'll look at 300 or 400 decks a year, and we're going to make 1 or 2 allocations. So we're passing on good stuff. We know that, and that's okay. You have to be comfortable letting it go to make sure that what you get is right. And so that was the lesson there. I went back to business school at USC. I don't know. I felt like I wanted to round out my education a little bit. I also kind of wanted to prove to myself that if I really focused, I could do better in school than I did in undergrad. I think my undergrad GPA was like 2.8 or 2.9.
Sure.
And, I would never go to class. I just show up for exams and not even study for those. So, it was kind of silly. So I got a 3.9 at USC. I got 1 B+ while I was there. And I was pretty proud of that. And so that was kind of for me, it was a kind of a prove it thing. I wanted to prove to myself I could do that. I went to a buy-side firm in Pasadena. We were about $2 billion when I started. We grew it to $19 billion and sold it. I retired for about a week and was going crazy. So I went to work for a competitor in town and worked there till June 30th of 2008. Left there, pretty fortuitous timing in general. Spent the rest of the year just kind of writing, and I created a blog that ultimately had about 4,400 subscribers to it. And it started out with clients just calling me, former clients calling me, "What's going on?" So I just sent out some charts and information, and pretty soon it was taking all day, every day to do it. So I started writing a note on Sunday nights and just sending it out, and people would just email me, "Hey, add these 3 people, add this, add my CFO, add my CEO, add all these people to the list." And it got to be a little unwieldy, but it was fun. I went to work for another family in Beverly Hills around that time period, basically doing effectively what I'm doing now. And they had some issues with their portfolio during the GFC. So the team came in and kind of fixed that. And then I took a little pit stop. I got a call from a recruiter who caught me in a weak moment, and I went to a regional bank, business bank, to run their wealth management practice. I'd never worked in a bank before, a real bank. And I thought, oh, this can be fun. it was a mess. It had a bunch of operational issues and compliance issues, and we got it fixed. Got the numbers great. The numbers were, we had the number 2 core fund in the country by the time I left, with low turnover, 6% turnover, and really just we, I think, did a pretty good job there. But it wasn't the right environment for me. This family contacted me because of George's health issues, and so we spent about a year talking, and I came over here. You asked about George and character. I mean, I think that those things kind of go hand in hand. George was very instrumental in the Republican Party here in Orange County. When I walked through his offices over here, there's pictures of him with Gerald Ford, Henry Kissinger, Ronald Reagan, both of the Bushes, pretty much every Republican leader. And he was kind of a big hitter in the Republican Party, served as the ambassador to Spain for George W. Bush from 2000 to 2004. And, just, I mean, a man who put his money where his mouth is was, when he went to Chapman, where I taught last year. By the way, it's George Argyros. The business school over there is the Argyros College of Business and Economics.
Sure.
And when the school was really struggling in the early 80s, I believe it was, George got together local alums and people, and they pretty much financially saved that university. And it's now considered a very good, private university here in Southern California. So he's was a very charitable guy. I say was, he's still here, but it was very charitable. We have a very large foundation. I think we might be the largest private foundation in Orange County. Certainly one of the most generous in Orange County. During COVID, his wife Julia, we doubled up a vast majority of our contributions to help out these organizations that were struggling and ready to close. So they're very generous on that side. And George is the utmost integrity. I'm going to look back here on my desk because there's a book, and if I can find it. It's a bio of George, and I think it's like a life well lived or something like that.
Oh wow, so, okay. So we can get it on Amazon, right?
You can get that on Amazon. Okay. Yeah, and I'll email you the name afterwards. I don't sit here and stare at my bookshelf for an hour. Yeah. So following that legacy, like I said, it was pretty daunting stepping in here. To step in underneath shoes of somebody who was that great of an investor.
Sure.
I feel like I'm decent at what I do. Certainly our numbers would suggest that we're doing a pretty good job, but he did the hard part. He made all this money. My job now is to keep it growing, without taking them out of the uber rich category. So that's my job number one, is make sure when I leave here they're still uber rich.
Yeah, no, that's helpful. So let's double click on that. I know we got about 12 minutes left, so I thought it'd be cool to just do rapid fire of a couple quick questions to kind of give the rundown. So when you guys look at asset allocation, how do you guys think about that across assets? And then maybe we can just, think about managers and how you look at managers as well.
Yeah. From an allocation standpoint, so we don't have, the kind of the typical 4 asset classes. That never made sense to me.
Sure.
That alternatives bucket, it's too diverse.
Mm-hmm.
Hey, I need to add to my alts bucket. Okay, what are you adding to? I'm adding a long only hedge fund. I'm adding a venture fund. I'm adding a emerging markets debt fund. I mean, there's all these different kind of investments in there. So we look at 3 assets. We've broken in 3 asset classes. We have a growth asset class, a defensive, and a real. And so our growth is basically anything that looks or acts like stocks, whether it's public or private. So if you've got a positive correlation to stocks, say north of 0.5, you're going to end up in there. So that's going to include our venture, our buyouts, private equity, obviously our stocks. They're all going to fall in that growth category. And we define that as that group is going to work when you have a moderate to fast growing economy with controlled inflation. Okay. Our defensive bucket is more bond-like. So, and not complete bond-like but it's non-correlated to stocks. So that would include our cash any bond portfolios that we might have, like municipal bond portfolios for the family themselves, any credit-oriented private equity strategies, non-correlated hedge funds, which we've used pretty extensively in lieu of bonds. And so that group is going to typically work. The non-correlated stuff is going to work regardless, or should, if we're doing a good job picking the managers. But in general, they're going to work in low inflationary environments, right? Think bonds and cash. And then our real assets are anything that comes out of the ground. Real is anything attached to the ground, real estate, oil, energy, commodities, that kind of stuff. So it does a little better in higher inflation environments. So when we want to tilt the portfolios and say, hey, we want to be more growth, more defensive, more real, we can base it off of kind of economic scenarios of here's our inflation outlook, here's our growth outlook. Ergo, we should be switching here and there. Now, then what we do inside there is a little different. If we've identified an idea, we think Egyptian cotton is the greatest investment in the world, we need to be in Egyptian cotton. We're just going to walk down the stack now. We're not tied to a structure. We're going to start with an ETF. Can we find an ETF that trades Egyptian cotton because it's cheap, it's liquid, and it's easy? Yes or no. Mutual fund, yes or no. Separately managed account, yes or no. Hedge fund, yes or no. Private equity account, yes or no. Hey, let's go fly to Egypt and buy some dirt. That's the kind of the process we go through.
Sure.
And at some point, sometimes we can't find the right vehicle. So that's how we kind of think about allocation.
Yeah, no, that's really helpful. I think just looking at it in just kind of verticals that you think strategically make sense just does make sense to me. So I kind of agree with that strategy. And then when you guys look at managers, what are some of the traits? Again, maybe we just make it simple: hard skills, soft skills, personality. As you kind of think about, classifying them within those three buckets.
Yeah, we're pretty definitive about what we do with funds. So we're typically not going to invest in a buyout fund that's over $700 million. And two reasons. One, as they get larger, fees become more profitable, and they become by default less incentivized or less driven by performance or less reliant on performance. We want to be aligned. I don't mind paying a 2 and 20 for a $500 million fund because I know they're barely running their business on that 2%, right? They're going to make their money on the carry. And hey, guess what? I'm going to make their money. I'm going to make money. If they make carry, that means they've made me money.
Sure.
So we're partners. So it's partially that smaller funds just typically tend to outperform, but not, it's not exclusionary. And then B, our thesis is that there's a lot of small businesses that are underinvested in that need to be improved. And there's growth opportunities for somebody who can come in, who understands how to improve a business and put capital back into these businesses. So we're focused there. And I think by keeping that cap on there at around 700 million, it keeps funds from migrating up and having, hey, I'm going to buy that $50 million EBITDA company instead of the $10 million one. The $10 million one is a lot more work than the $50 million one. This $50 million one looks great. That's true. It should, except there's less value creation available on the $50 million one than there is on the 10. I want you buying the 10, right? Put the work in, roll up your sleeves. Let's do this. Let's make this work. Because private equity is, how do you buy it? How do you sell it? Sometimes driven by the marketplace, sometimes driven by some skill. But what do you do while you own it? How do you create value? That's repeatable. So that's why we're focused there. So when we're looking at managers, we're looking at managers who understand that there's an opportunity to improve, build, and grow businesses. And that's our main focus.
Sure.
It bleeds over a little bit into our venture stuff. We also invest in seed venture. We tend to not invest with the larger funds. We kind of have we had a softish cap at 100. We're kind of now maybe 150, just because that seems to be the fund size that people are raising to 100 or 150. Excuse me. And we're looking for people with a unique edge, something different that we're not seeing in the rest of the portfolio, something different that we're not seeing from others. Hard to grab sometimes. At the end of the day, we're going to do a ton of work. We're going to throw out most of the things we look at. And when we get down to those final few, it comes to, there's a gut feel. And that's the part I have trouble quantifying and teaching, because it's just a feeling. It's that pattern recognition. It's I've seen this before. I feel this is right. Somewhere it's right that you can't put your finger on why. and you make that's that last 5 to 10% of the investment decision, and that's the hard part to teach, that intuition.
Sure. Yeah. I mean, going back to relationships, right? I mean, when you finally make the decision, it's kind of how you feel. And even when you choose your partner, right? I mean, we talked about this when we got lunch. I mean, it's just, the ability to just kind of trust your instincts when you choose, because once you choose that partner, you've chosen them, and there's ramifications if it doesn't work out.
That's right.
So I think there's no real science or analytics that you can really use at that point, right? You're really just going to pull the trigger or not, right? It's a decision. When you talked about the restructuring experience, I think about Sam Zell, because I mean, one of the things that he talked about in his book was, they call him the grave dancer, right? Focusing on how the company is going to blow up front, and think about how it could go wrong. And sometimes that's the ability to face your demons, and some people can't do that. So when you think about hard assets, I think it's really interesting, because when you're buying these businesses, the interesting thing about hard assets is access to possibly liquidity. If you could sell some of those assets, or sell them at a higher price, then you got some appreciation that goes along with just the actual investable capital that's going into the whatever the vehicle is. But I thought that's pretty interesting. And I'm just kind of nerding out here as we kind of wrap up here, but what are some kind of hard assets or some trends that you're seeing in the real asset space?
Yeah, I think there's an opportunity evolving in multifamily for kind of and I don't know how you want to phrase the piece of paper. Is it a mezz piece? Is it a pref equity piece? Where in 19, 20, 21, maybe 22, people were paying, 3.5, 4 cap rates, which is expensive, right, from a valuation standpoint, for multifamily assets, and getting financing at 4.5, really tight spreads. Most of that paper is 5 years, so it's starting to roll over. And if you've got a lot of leverage on that property, and you're going from pick the number, I'm at 5, I'm going to 7. It may not appraise now because I paid a 4 cap and maybe it's trading at a 5.5 cap. I may not be able to get all the financing to take out that mortgage. So I'm going to need to attract outside equity. I think the opportunity there is, I mean, I don't know how you price that paper. Mm-hmm. Excuse me. I've seen between 16 and 18% kind of cost on that, mostly in kind of a PIK structure. But I think that's an interesting opportunity where you're getting stabilized assets. Mm-hmm. Pretty predictable cash flow streams. Not a ton of growth there, but it's pretty predictable what's going on. Where you can step in and get a pretty good return on this thing, and ultimately end up, if you really want, you could probably end up with control of these properties at some point. So I think that's an interesting opportunity in the kind of the harder asset space. Yeah. You mentioned Sam Zell, and I have to say this because if I don't, I'll be remiss. So Sam and George, my boss, or the head of our family, we're good friends.
Oh, wow. Okay.
And so when George was the ambassador to Spain, the story goes that somebody from the front came up and said, "Hey, Ambassador Argyros, there's a guy outside on his motorcycle who says he's a friend of yours and wants to say hello." And it was Sam, who had been riding his motorcycle around Europe and stopped by to say hello. So
that's amazing. Yeah, I mean, it's very fortunate to learn from great people like that. And then, I think the responsibility that you bear is, carrying that legacy, which you're doing a great job doing. And it was amazing learning from you. I had no idea that you had the connection to Sam. I just when you started talking about hard assets, that was the first person I could think of. And look, I just want to say thank you for giving me your time. All these stories, kind of learning about kind of the hard skills and soft skills that are needed, I don't think are really publicly available as much as they should be. And sometimes it's hard because you got to be in those ecosystems. You have to have those relationships. So just want to say thanks again, Ned.
Thank you. I enjoyed it. Always a pleasure talking, Joel. I look forward to talking to you again soon, and hopefully it was beneficial. So
yeah, this was amazing. Well, thanks a lot, everybody else. Have a good day, and we'll all catch up soon.
Happy St. Patrick's Day.
Take care. Yeah, happy St. Patty's. That's right. All right, guys. Bye.